We really encourage advisors to look to using bonds or fixed income instruments to generate the income that their clients are looking for. The recent past has been a very challenging time to try and construct a portfolio to generate income because of where interest rates were. But now, the Fed has begun raising rates, and they have moved up to a point where it is a viable asset class to generate income if the portfolio is constructed properly and managed properly. By using an individually tailored portfolio that's specifically for an individual client, where they own those bonds themselves, they get the benefit of having that designed and managed specifically for their objectives. And when you're talking about certain objectives like tax position, that can be very important. So the challenge with mutual funds is that you can go out and try and find a fund that most closely matches the objectives of your client. However, they still, at best, are just they own a pro rata share of that fund. So there's a considerable amount of activity going on in any one fund at any one time. Money coming in that has to be deployed, money going out, securities have to be sold. An investor gets their pro rata share of all of that activity that is really, doesn't pertain to them. If an investor owns their own bonds, you've done that, you've constructed a portfolio to generate a level of income, a consistent level of income. If the market volatility causes the price of those bonds to move, if you don't have to sell the bonds, it's just not an issue. You still receive the income stream that you were contracted for when you bought the bonds. Over time, those bonds will come back and they mature at par. So provided that you don't have to sell, it's really just an opportunity cost one way or the other. You should be focused on the income that's being generated from those securities.